Okay, so while we wait for a few more people to come in, I think it's fair that I kick off by welcoming everybody. So, hi, good afternoon, namaskar. Welcome to this webinar of Buoyant Capital, wherein we intend to explore, explain, and expatiate on our theme, our core theme and method and framework of investing, which is cross cycle investing. And it's a very good time, to um, talk about this style or this philosophy or this framework, simply because we are going through the throes of a cycle yielding to another cycle. The dramatic pullback from COVID seems to have tapered off. People are getting into all kinds of worries about whether there's going to be a global recession, interest rate hikes, inflation. All of these are seen as value destroyers in the stock market, and suddenly nothing could go wrong has changed into everything may go wrong, and hence it's a classic time to bring into sharp focus the approach of investing across cycles that we use. We have a certain way to look at these cycles. We break that up into how we look at the market, we look at sectors and stocks, and how we ascribe certain characteristics and what buckets we put them into. And then this entire cross cycle investing framework allegedly helps us invest better than what we would otherwise have done. Some of those metrics will come out when Jigar shares our performance data for the last trailing 6 years, 73 months actually, with you guys. And hopefully it's a testimonial to the solidity of the approach and not any individual brilliance that we want to tom-tom. And we believe that this approach will take us forward in the times to come. Interestingly, this is the only investment style or even fund that we run right now in the PMS business. We are making us another product called the all-weather strategy, which is different, which goes across equity into other asset classes also. But within equity, this is the only. We are a monoline equity fund, if you can call us that. So over to Jigar. Um, if you can pull out your deck and then walk us through it.
Right, Dipen. Thank you, and thank you everyone for joining in today. Uh, I think as Deepan mentioned, we'll first run you through, what is it that we do and we have done over the last a little over 6 years. There are another sort of notations that I have made with regards to how we see things, but I understand most of you are new to Buoyant Capital. So let me first start by, highlighting what is it that we have done over the. Is my screen visible?
Yes, very much. Yeah.
All right. Yes, so I'll start with the key concepts and key differentiators that make Buoyant Capital different. I'm actually here not sort of going into the traditional versus alternatives ka debate, and even within the alternatives, how what sets us apart. But suffice it to mention at this point that primarily speaking, there are two large schools of thought as far as alternatives is concerned. Mutual funds obviously are a very different animal. Their average ticket size is 70,000 rupees for retail. For PMS, it is 50 lakhs. For AIFs, it is 1 crore. And the sheer size that they have amassed over the last few years makes it a very different engine to run. The mutual funds, that is. Alternatives, on the other hand, have a stated strategy. They want to, execute that strategy, and it takes a lot of communication, a one-on-one communication at times, to make sure that the fund returns and the individual returns are as close as possible. They are also quite nimble in terms of what they want to achieve, and that's what made alternatives a very interesting. I'm hearing some noise. Can you
Yeah.
request everyone to put?
Yeah. We are good to go.
Okay, so that's what has made alternatives as a platform that has emerged over the last few years and taken the fancy of a lot of people with an investment surplus over a certain number. Within that, as I said, within alternatives, there are two broad schools of thought. One school of thought essentially is that if you reach out to somebody and say that, look, I want to give you money for 10 years, they'll come back to you and say that, okay, I have to find out 10 companies where I can invest for 10 years or 20 companies where I can invest for 10 years. That and the underlying messaging there clearly is that, we believe that once you find a good company, that's where your job.
Sound वगैरह हो गया.
Nitin, will you mind muting everybody?
Yes, sorry, carry on.
So the first school of thought is that they'll find out 10 or 20 or 25 companies where they can stay invested for all those 10 years. And the underlying belief is that a good company is a great investment at all points in time. Right, that has its merits, and people look at different data differently. We do not believe that that is a sustainable way of running money. We believe a good company may or may not be a great investment. If it's offered to you at a reasonable valuation, then it is a great investment. Otherwise, paying top dollar for an mediocre asset or even a good asset is not something that will allow you to run superior returns. And that's where our framework essentially starts. If what Deepen sort of introduced as cross cycle investing or as business cycle investing, we believe there is a time when a lot of good quality businesses are offered to us at very attractive valuations, something like August 2021, when everybody was totally into buying the next multi-bagger. And a lot of quality business then were at very reasonable valuations. But equally, there are times where the market is totally incongruous. They are not looking at a wide variety of businesses which can traditionally be bucketed under bad businesses, but they turn out to be great investments. And it is our job to evaluate those businesses and take positions depending on the cyclical stance we are in. This will sort of start making a lot more sense once I, present to you. So we'll come to it in a lot more detail. But here we are presenting the 5 or 6 attributes that make Buoyant Capital very different. We started the fund in June 2016, so it's 6 years, 1 month, or 73 months, as Deepen pointed out. During that time, we have generated 18.9% post fees and expenses. Kotak Mahindra Bank and HDFC are our two fund accounting partners. They are the ones that generate the NAV. We take that NAV and we just present the numbers. So essentially, the client books are maintained by them. The auditors for HDFC and Kotak actually audit these accounts, and they send us the details, which is then re-audited by our auditors. So these are as clean the number as come post all our fees, post all expenses, and across the pool of investors, which essentially makes us top 3, for any fund which has completed 5 years. It can be a mutual fund, AIF, PMS, any strategy. We would be there, right up there in terms of return performance. Now, returns is one part. How the returns are generated is another. Here I should mention that CRISIL did a study which looked at not just returns, but also the standard deviation or volatility of those returns, the sectoral concentration that was applied in arriving those returns. When Nasdaq was great, you could be very tech heavy, and that could have led to your outperformance, but you would have fallen in line with the Nasdaq fall. CRISIL went through all of those data. They also went through the liquidity analysis for the 3 years ending December 2021, and of the 92 schemes that they evaluated, only 4 managed to get 5-star ratings, and very happy to report that Buoyant was one of them. So that is as far as the output go. 6 years, a lot has been thrown as regards the market. Started with Demon in 2016, GST in 2017, ILFS crisis in 2018, then 2 rounds of pandemic. So the fund has seen a reasonable amount of activity in terms of externalities, both manageable and not manageable. But we believe we have done a fairly decent job in maneuvering through that. Let me now spend a lot of time on what goes into creating those numbers. I'll start with the team. 4 of us with 20 years plus experience. Deepen, a lot of you might know, is BTech from IIM Kanpur and MBA from IIM Calcutta. He was last running HDFC Securities as head equities. and has a very illustrious experience in terms of sell side and to some extent, dabbling into buy side as well. Viral, MBA from IIM Ahmedabad, chartered accountant, 22 years of experience, was last the CIO of SL Mutual Fund. Before that, with Reliance Life Insurance, used to run almost 23,000 crores in debt and equity assets. I am a CA and CFA from AIMR US. I was last the director of research for HSBC Bank. My job was to advise foreign institutions, the likes of Government of Singapore, Abu Dhabi, Capital, Fidelity, etc., on how and where to invest in India. So, all those FII numbers that we see every day, every week, those were our predominant clients. And Sachin also was the CA and a CW and was with Reliance Mutual Fund. Now, here I must mention that there is a difference in how we are structured versus a lot of our peers would be structured, in that, we most of our peers would have one fund manager with a decent team reporting into him. That creates problem, because when an analyst graduates from becoming an analyst and into a fund manager, he would have sort of the experience of looking at 2 or 3 sectors very deeply. But besides that, for somebody who has done consumption investing all his life or analysis all his life, suddenly turning around and starting to invest in commodities or turnaround plays is not easy. Relatively, 4 of us have spent, our time in different sectors. That allows us a very cross-cyclical understanding of how each and every sectors behave. And as data will later suggest, we are able to participate in each cycles because of that. Strategy, as I said, I'll come to it in a lot more detail. The second last point is in terms of execution. And execution is very important, because unlike a mutual fund or an AIF, where the trust is independent of inflows or outflows, whenever you put in money into a mutual fund, you get the NAV of that date. Same is the case with AIF. But that essentially implies that you are 100% invested on day one. I think that is a very sad way of running money, for the lack of a better word, because if you have 20 businesses, when the money hits the account, not all 20 are buys on those days. We may be in the process of exiting 3 or 4 of them. There is no point buying those shares into the new money that we receive and then selling them a week, a month down the line. And also, we might be, say, very interested in banking, but we know FIs are selling, and banks are the exposure they have most. And therefore, we'll be able to buy off banks in a slightly staggered way, which will be more beneficial to portfolio creation. Sadly, the 350 accounts that we run, or the multiples of that that our peers run, it's virtually impossible to run these things on an Excel, or not possible manually. And therefore, all of them have also stuck to doing it on a model portfolio basis, which is not ideal. We sat down with an IT company. We have created a solution where, the money hits us, you are never 100% invested on day one. And therefore, to a very large extent, the question of timing the market is, not something that you have to decide on. You could have given us money at 18,500 in October, and you would still not have been fully invested until April. You could have given it again to us in April, and you would not have been fully invested even now. So depending on how aggressive or defensive we are, we take those calibrated stances. If we are aggressive, we get fully invested in about a couple of weeks. If we are defensive, we get fully invested in about half a year or so. At times we have taken 8 months, but that sort of, allows us to build the portfolio depending on how good or bad we see the market. The last and not by any means the least point is that, while we are analyzing the drawbacks of a lot of the system that exist in investing and managing money, one of the predominant ones is, the sort of non-alignment of interest between investors and their fund managers. SEBI has been trying to do something in this regard by mandating fund managers to put their money and run it only through Buoyant Capital, sorry, run it only through their funds. We have suo taken cognizance of this, and we have gone a step ahead. We, 4 of us run money only through Buoyant Capital. Buoyant Capital directors and relatives have a total value of something in excess of 30 crores as we last speak, which is run in the exact same way like we run all our investors' money. So we don't have shares that are not in our client account and vice versa. And that brings in an amount of synchronity, that is very, very required as you go ahead. Having dealt with now the six key attributes, let me sort of break the further discussion down in two large points. One is how we see the markets, and then how we operate in the markets that we see. The underlying point here is that human mind thinks in linear terms. You go from point A to point B, significant amount of time passes, and we fail to understand the mind, given the complexity of the data that's existing, will try to draw it in straight lines. Even forget 20-25 years. If you go back and look at COVID, all of us largely remember that it was how great a buying opportunity that was. But while you are in that period, there are a lot of cycles, there are a lot of questions, there are a lot of volatility that needs to be taken into cognizance, and anything that is of value essentially operates in cycles. I have a lot of data to prove it, but that's something we deeply believe in. I'll start with market caps, move on to sectors, and then to stocks. But some amount of data, and if you can try and correlate with the era that I mentioned, it might be very helpful. So brisk look here at this slide. We have broken it down into two parts. On all the top half are up cycles. On the bottom half are down cycles. The dark gray bar is the small cap index, light gray is the mid cap, and the red bar is Sensex. Now a cursory look here will tell you that whenever we are in an up cycle, small and mid cap outperforms large cap. Whenever we are in a down cycle, they underperform. Very intuitive, all of us know this. But when you are in a cycle like this, and this is why if you can jog your memory back, December 17 to March 20, the large cap index was down 12%, the small cap index was down 50%. And at this point in time, the primary market chatter, the primary market understanding was that in India, there are only this 20-25 great companies to be invested in. FIs will only invest here. Domestic investors know they'll only invest here. And therefore, this is the only space in India that requires any investor attention. However, when the cycles turned around, the small cap index is already up 200%. This large cap index is up half of that, and the entire underperformance of a little less than 3 years here was taken out within the first 1.5 years. So essentially, here when small and mid cap are doing best, small cap managers are the rock stars. I don't want to take names in this presentation, but if you are aware, a few small cap managers were, gathering the most amount of incremental capital. Here, the largest amount of assets were taken under by large cap managers, peddling this narrative that large caps are the only places you should be invested in. And here the small cap investors are flying high again. Buoyant Capital was not number one in this period, or this period. But when you sort of combine these three eras, we would emerge as number one because we believe the cycles exist and we will, formulate our strategy accordingly. A similar case exists in terms of your sectoral breakdowns. So this is 22 years of Sensex broken down in 10 cycles. Some cycles are fairly intuitive. Some may require some amount of deliberation. But you look at this COVID downturn, FMCG was the best performing index, metals was the worst. When you look at the sort of climb up again, metals became the best performing sector, FMCG was the worst. There was a very short period of time, very recent in our memory, we remember this cycle existed. But you just go back to the previous cycle. In the taper tantrum downturn, consumer durables was the best performing sector. In this upturn again, consumers became the best performing sector. This went on almost from September 14 to, I would say, September 19. So for that 5 years, market, irrespective of cycles, was rewarding consumption facing companies. And again, the market narrative became that you should invest only in consumption facing names. These are companies with great moats. They have taken price increases even when cost hasn't gone up, and all that has flown to PBT. They have reported consecutive increase in revenues for each year. The return ratios are so stellar that a 50p or 100p doesn't matter. These are companies you invest for in life and forget about it. The fact of the matter is that during this time, inflation was so tepid that there was virtually no inflation, either from commodities or crude. And any price increase that took went to the PBT. And had you bought these assets here at the peak of COVID, over the last 3 years, you have not been generating any money. They're virtually flat. It's not the first time this happens. Capital goods was a similar cycle for 8 years. The index was up some 30 times, stocks were up 200 times, and everybody wanted to sort of buy capital goods companies. Companies themselves drank that Kool-Aid and started borrowing heavily, which led to the subsequent NPA cycle. But had you managed to buy capital goods here, it would have taken 11 years for you to make good on your investment. I'm saying make good as in come back to 0% returns. And this is not the first time, right? And not the only sector where you have had these cycles. IT, for example, right, over the last 20 years had underperformed for the first 10 years. FMCG for last 10 years had last 20 years had underperformed for 10 years. And automobiles, again, underperformance for the last 10 years. So not just market caps are operating in cycles, sectors are operating in cycles, and I'll go a step ahead and say that stocks are also operating in cycles. And that is essentially where I started by saying that, two broad schools of thought. One, that people believe that a good company is a great investment at all points in time. We have chosen these 4 companies, but I have at least 30 more in my Rolodex where I can pull up a company and show it to you that the companies were always great, but for an extended period of time, they reported very muted numbers. And by numbers, I mean return ratios. Uh, take this Coca-Cola, for example. Warren Buffett bought it in 88. In the next 10 years, the stock went up 10 times. It got re-rated from 15 PE to 50 PE, and people continued believing that this is a great investment at 50 PE. But over the next 19 years, when its EPS continued to double, stock return was zero because you paid such a huge premium valuation to buy this asset at start that whatever good the company did over the next 2 decades was virtually paid for at the time when you are buying this asset. IBM 12 years, EPS tripled, stock return zero. Colgate 15 years, EPS quadrupled, right? A lot of companies will give an arm and a leg for a 10% compounded return in earnings. But for that 15 years, stock returns was virtually zero. So not just market cap, not just sectors, even companies essentially operate in cycle. And the best way then to invest is through cycles. The first 2 slides are essentially, sort of theoretical slides on how we operate. And then over the next 2 slides, I'll give out details on what we have done over the last 6 years. So what we do is we break up our investments into 2 broad categories. One that is core to our investing, other which we call satellite. Core basically is what 70-80% of the market is focused on, which means finding a good company. They have predictable cash flows, they are industry leaders, they generate so much cash they don't need it for growth, and they therefore have a very decent reinvestment slash capital structure that they can work off. Uh, there is a slight difference in our thought process versus the street here. The street thinks that this is the only investable universe. We believe this is an important investment universe, but not the only one. We believe satellite is equally important, and we further break down satellite in cyclicals, turnaround, and value. Cyclicals are your typical cyclicals. You might be willing to listen to cyclical investing today, but 3-4 years back, take say Tata Steel between 2019 and 1999. Right, for those 20 years, at the start of the cycle, Tata Steel was $275. At the end of the cycle, it was still $275. And one way of looking at this was that, look, this over 20 years doesn't generate any money. So forget about it. It doesn't matter. We look at the same data set and realize that Tata Steel was below 300 on 3 separate occasions. It was above 800 on 3 separate occasions. Can we have a risk structure which is so secure that it will allow us to participate in the entire process? We sort of concede that nobody can buy at the bottom and sell at the virtual top. But even if you are there for part of the ride, you can make very decent returns. In the next slides, I'll come to what we have done. But that is our endeavor. It could be a 2-3 year cycle of metals. It could be a 5-6 year cycles of CV. It could be 8-9 years of NBFCs versus banks. But essentially, unless you have a cyclical mind frame, as we discussed, you're not even willing to look at different sectors and market caps operating cycles. That itself is detrimental. In this part of investing, we slightly sharpen the focus and say, can we invest in these companies? The second subcategory is turnaround. Again, you would classify companies in this sub segment as bad companies, but they end up becoming great investments, right? Take Bharti versus Jio. When Jio came in, There were 13 telecom companies when Jio was done with its freebie offer. There were only three. Now, at the peak of that disruption, it would look like Bharti is a very bad investment. Like this company is losing customers to Jio. It's reporting negative revenue growth. It's reporting losses. It has to invest for 4G infrastructure and spectrum due payments and therefore negative cash flows. So from every angle, a bad company. But whatever Geo did not manage to kill, all of them got very, very strong at the end of that, rampage, if I can call it that. And Bharti became 3x from there. We allocate some amount of capital in finding businesses which we think can turn around. The extent of capital we are willing to put through and all I'll come to in the next slide, but this is an important area of investment for us. And the third part is value, or if I can expand that to mean value migration. Now, leadership is a very important trait in our markets. People are very happy to pay, a huge premium to leader companies, even if they are not the best run businesses. The best example here is the case of, say, HDFC Life versus Max Financial. HDFC Bank is a great bank, right? Over 25 years, it has shown how good, what essentially a good bank is supposed to do. But HDFC Life is a mediocre life insurer. Max Financial, in whichever parameter, you could look at the agency force, or you look at the product sort of portfolio that they have vis-a-vis anybody else, or even the pure numbers, return on embedded value, or VNB margins, and it will appear that Max is a superior business. But because of the Max parentage, when we first bought it, it was trading at 25% valuation to HDFC Life. And over time, we have realized that a better run business does get its due. And we want to get positioned into that migration that happens. If you think it happens in a lowly life insurance sector, you could look at what's happening over the last 3 years in ICICI Bank versus HDFC Bank. So, core important to our investments, but not the only sector. We want to invest in satellite as well. And how much are we willing to go there depends on what stance we are having. We could have an aggressive stance, at which point in time we want to generate superior returns. When we bump up satellite to 70, reduce core to 30. Having generated superior returns, we want to protect the capital, at which point we turn defensive. We bump down satellite to 30 at that point in time and bump up core to 70. Easier said than done in theory. Let me run you through what we have done in practice. So over the last 6 years, this is what, and arguably, one of the more important slides. So allow me a moment to explain this. The gray bar here is the benchmark, which is BSE 100. The red bar here is Buoyant Capital. So since inception, basically 73 months, the benchmark has invested 76% capital into sectors that we think are core and generated 83% returns. In comparison, Buoyant has invested 42% capital. I told you we'll do 30 when aggressive, 70 when defensive. The weighted average is 42%. So we have invested slightly more than half the weight into this sector, and we have generated a superior return. Right? This happens in our assessment because of the way we are structured. Within core, we are able to identify which sectors to get positioned in, within which sectors, which companies can drive a superior return, and that sort of is on full display here. But more importantly, we are able to invest a higher proportion into satellite sector. Market is at a much lower number, but look at what market does. It's just at 10.4%. They'll show you this number and say, forget about investing in satellite, forget cyclicals turnaround, it doesn't make money. We look at it, the same database, and ask whether our risk can be strong enough to generate the returns that we have delivered. For cyclicals, we are at 2.5 times capital. We are at 5.1 times returns. Turnaround, we are at 3.5 times capital. The benchmark is at a negative number. We are at 27%. Right. So not just core, not just satellite, but even within subcategories, we have been able to generate a much superior return. And if I can slice that same data differently in terms of time zones, we started the fund fairly aggressive in June, ran it like that till October, generated 63% return. This is the small cap, mid cap, and large cap index. We beat all of them. At which point in time we turned defensive. The market actually peaked in Jan. We were defensive by October. The broader market post the long-term capital gains budget was down. Our idea was to protect the capital, which we have done. Over the next few months, we became aggressive again, ran it till August 2021, at which point we generated 72% return, did the best inline returns. And since August 2021, we have been running a defensive portfolio. This number shows 4.6, but if I take returns until yesterday, we are breaking even on this as well. So we'll continue to run a defensive stance. The idea is to protect capital. Having generated a superior number, we would have, given the concentrated portfolio we run plus the very large fee event that we had, we would have expected this number to see a lot bigger on the negative side, but we have managed to arrest that flow. This is what essentially, the numbers look like: 1 month, 3 month, 1 year, 2 year, 3 year, 5 year, 6 years. Broadly, since inception, we are at 93. The benchmark is at 93%. We are slightly more than 2x on that number. Lastly, I started by saying that one of the most advantageous point of running an alternatives fund is the ability for us to communicate with our end investors and suggest what is it that we are trying to implement. And to that end, we take a huge effort to make sure that we communicate what we are doing, and the end investor is in consonance, because you would remember we turned defensive in October 17, and the market peaked in Jan. Same way we became aggressive in Feb 2019. The market picked up with the corporate tax cuts in September 2020, September 19. So there is a extended period of time, sometimes months, after, when the fund actually doesn't do as well as the market. But what we are trying to do is trying to capture the cycles, as I showed to you at the start of the period, that when you combine a particular time zone, Buoyant will not be number one, but when you combine 2 or 3 time zones, Buoyant would come in the top decile. To that end, we declare our portfolio daily. There are very few funds who do that. We also give out our entire transaction summary. So if you are keen on actually observing what is it that we do, you can do it in the login that we provide. Every week I write a letter. It's now published in the Economic Times. I have written 91 columns so far, and would pick up a topic. For example, when Nykaa and Paytm were going bonkers, we decided not to invest in them and wrote an article on why the street could be wrong in just looking at the India addressable market, when they should ideally be looking at the US 10-year treasury rate. And at that time, the Fed fund target rate was below 25 basis points. I've written on cement, I've written on aluminium. All of that is on our website. If you are keen to go through that, all the 91 letters are there on our website, but that helps us communicate and put forth our argument in a lot more detail. On a monthly basis, we put out detailed portfolio fact sheets. Some of the snippets we had put out in that PPT, but that again is on our website. In the weekly column, we don't talk about where we see the market and our position per se, but only a very specific point we want to make. In the fact sheet, we will, display on how the fund has done over the last month. What is it that we are trying to execute, and how do we see the allocation decisions. Quarterly and an annual basis, we put out detailed portfolio analytics, taxation reports, etc. And last but not the least, all our media appearances, 130 of them, are put up on our website. The simple idea essentially is that, we basically, it's one thing for us to say that in August 2021 we became defensive, but if you go back and check all our media interviews, which is essentially a time stamped truth, so to speak, they would all resonate with what I'm communicating today. So in summary, what is it that we do is a stock selection engine like all our peers. Within that, we don't have a senior most sort of analytics team or research team, but we more than make up by the way we are structured in terms of decision making, in terms of playing across sectors and cycles. We believe we are up there. We layer it with cycles. We have run only one fund since inception. If we think small and mid cap make more sense, we can incorporate it here. If we think large cap makes more sense, we can incorporate it here. We overlay it with aggressive and defensive cycles. So the end investors, you could actually focus on running your business or doing your job, and actually not have to worry whether small cap में पैसा डाले कि pharma fund ले कि finance fund ले. We can do that for you. And last but not the least, we we have a special sort of affinity to execution. We believe the strategy is only as good as the execution, and therefore the software that we deploy essentially allows us to, run the portfolio as if it is the only portfolio we are running. So that, ladies and gentlemen, was briefly what I wanted to communicate regarding what Buoyant is. Very happy to answer questions if you have them, or we can run you through our current views on the global markets, India markets, and what we are seeing. Dipen?
Yeah, so we'll open it up to Q&A. So you can type your questions on the chat window, or you can raise a hand or give me a reaction, and I will enable the mic for you. We'll wait for a few questions or whatever to come in, but yeah. So you might have questions on, the investing style. You might have questions on the claim that Jigar made about running a custom portfolio, or at least a curated portfolio for everyone. Despite having now what, Jigar, we have about 320 accounts now, 330 or
close to that, yes.
Yeah. So, okay.
Anshu had a question. The fee structure is fairly standard. We have three fee structures. One is a fixed only at 2%. Fixed, one is variable only at 0%, fixed hurdle rate 8%, and 20% sharing over and above 8. So for absolute clarity, if we generate 12% returns, we'll be charging fees only on the incremental 4, and that's 20%. So 80 basis points is what we retain. 11.2% is what you retain. And the third one is a hybrid one where 1% fixed, and the hurdle moves up to 15%. So those are the fee structures. I think that's pretty much in consonance to what everybody else is. If anything, we are arguably on the lower side.
Yeah.
That depends. So if we don't have questions, I'll briefly summarize our, what is the cash in hand in defensive mode? What is the cash percentage now? Right. So cash percentage today is roughly about 5%. In April, it was something like 16%. In the defensive zone, we are finding a lot more businesses today that are very attractive. We'll continue to remain defensive and deploy the cash. We are somewhere around 45% on core now. We were at the peak of our defensive stance somewhere around 60%. We have started trimming that down to 45 and started deploying cash. We believe over the next 2 to 3 sort of months, you will have opportunity in the market where it would make a lot of sense to get fully deployed and get aggressive. We are waiting for that time to arrive, and by which time we would come down to 1 to 2% cash. We would have a significant higher sort of stake in the satellite portfolio.
Yeah, just to add to that, we've been asked a number of times, one, why do we take so long to deploy? I think much of that has been answered by Jigar, that since we are running an individual portfolio for each one of you in the PMS, we'll wait for the right price. Sometimes we get it within the month, sometimes we don't get it for 2 months or something. So you might see that we've invested only 20-30% of your money for the first 2 months, especially when we are in defensive mode. That is one bit. The second one is that this entire thing of trying to beat the market in every time interval doesn't work. So if you look at our latest return profile, you'll see that we've underperformed for the last 3 months or 6 months or something. And it's not pleasing, but it's nothing that bugs us. We are okay to be the way we are and deploy opportunistically and get a little bit of underperformance from time to time. We are perfectly okay with that.
All right, so let me briefly run you through over the next 10 minutes or so what are our current thoughts on the market. And if you have questions in between, please feel free to ask them. So I'll start with the most fundamental fabric which India enjoys today. That essentially is that whenever you're looking at an economy from an economy standpoint, you need more number of people working, that's labor force participation, and you need people to work much more productively, which is the productivity gains. And if that fundamental fabric is right, which is not the case with Japan over the last 30 years, if you want to compare, then that economy will likely do a lot better. During that time, obviously, India will have 10 crore people joining over the next few years. You might argue, कि अरे भाई jobs कहाँ हैं? So it's a very simple thing to do it is that today, those people are actually withdrawing. They are currently freeloaders, if I can call them. They are withdrawing from the economy. Even if they manage to get some job, do some amount of work from, withdrawing from the economy, they become contributors, which is a huge swing. So in the fundamental fabric, India is reasonably good. The policy action that's been taken over the last 5-6 years that I mentioned, it's very evident from the fact that the GST collection growth is higher than IT collection, which is higher than your nominal GDP growth. So a large amount of economy is getting organized, and that sort of helps a lot. Change takes times, but both the demography and the geopolitics that India is in, we find that it's going to be a reasonably good space to be invested in. In between that, there are a few bumps along the way. What we are talking is 10-15 years, but it's not a straight line. As I said, it will always be cycles, and these cycles will present and manifest itself in terms of global fundamentals and liquidity. Years of QE, federal balance sheet has actually been bloated. They don't really know what to do with it, essentially, and they're trying to quantitative tighten it. None of us have had any experiences of how to invest in a QT scenario. And to add on top of it, Russia, Ukraine has made the problem even more worse. A large part of inflation is emanating from supply constraints, but since a fiscal policy or a monetary policy cannot address supply constraint, the only thing they have left to do is to crush the economy, crush the demand, which they will likely do by increasing rates very rapidly. Having said that, inflation, the way federal governments and monetary policy enthusiasts look at inflation is very funny. You go from 100 to 120, that's a 20% inflation. 120 staying 120 is 0% inflation. Right, so without reducing the prices, you have managed to bring inflation under control, and that base effect will start getting evident from September, October onwards. So over the next 2 or 3 months, you will see, all the central banks making a lot of gestures, suggesting that they are okay with the recession. But it is our understanding or belief that you might actually avert a whole recession completely, and you will be able to run away with this. In the process, liquidity assumes a lot of importance because at times when the US is raising rates, any avenue that you thought is a safe haven is busted, right? Cryptos are busted, commodities are busted. US becomes the sole prerogative of all investors worldwide. And that also leads to liquidity situations in India, where FIs have now sold close to 3.5 lakh crores. You look at it from an FI portfolio's perspective, they only sold 5.5% of their holding. Push comes to shove, 6% cash call is something that any of us will take in a blinker. And therefore, it's not a huge number, but that definitely creates a scare in the market that FIs are withdrawing. Look, there's some problem with India, and retail participation falls. And also, it creates dislocations in some sectors like banking, where they have disproportionate over ownership stakes, and that they can only sell what they own. And because they are selling that, it creates a huge opportunity. So people like us take huge advantages of situations like this. We were somewhere around 25% banking and insurance stake. We are close to 30% in December. We are now close to 35-36%, which is the max that will go. At the same time, domestic liquidity has managed to sort of hold us together. Domestic liquidity flow into mutual funds has been at record high despite the challenges that have presented themselves. Historically speaking, a time when 1 year return goes negative and FD rates come to about 6-7%, that's the time when you are looking at a very different flow situation from a historical standpoint. Now that situation hasn't manifested since 2016 when demon was set in. And no matter how many jokes are made about demon, or even the government stops recalling it as one of their great plans, but we believe that that has gone a long way in addressing the parallel economy, and people are virtually afraid of keeping cash, which keeps the inflow into mutual funds rocking. And that's something which we will expect will continue to happen. Currently, we are only at about 5% of domestic savings into equities. Developed markets are somewhere closer to 50%. It's not right to compare India to US in every aspect, but 5% is too low a number. So essentially, we'll go somewhere higher than that. Results. So obviously the two cycles that I mentioned will have to play through that. In between, we'll keep evaluating the fundamental fabric in the lens of results that come through, and banking results, Reliance results all are expected to be reasonably okay. Tech, the numbers were okay. Valuation wise, we followed Nasdaq, failing to understand that we don't really have any tech companies. What we have is IT services. Zoom can go up 10 times in a year in terms of revenue. TCS or Infosys will never be able to do that. So essentially, we have IT services company. They should never have been valued at 30 times. And now we are seeing the backlash of that when, even TCS has corrected in excess of 25%. But results are okay. FMCG is okay. The real problem India has is in terms of crude. Last year we paid $75. Today we are at 110, which essentially increases the cost of India by 5 lakh crore, of which only 2.5 lakh crore is passed on. Government has subsumed 1 lakh crores in lower excise, and the other 1.5 lakh crore has been passed on. So this balance 2.5 lakh crore needs to be absorbed. India's profit base is only 7.5 lakh crore per year. So essentially, we'll have to go down to sectors that can essentially pass that on. And that's how we will tackle the investing in India. But the bottom line is that, we have corrected reasonably well. We were short of ideas in August 2021. That's no longer the case now. We are defensive, yes. We will first run through with cash. We will then sort of run down on core and get up on satellites. And that's when we would have turned fully aggressive. Given the dot plot that we see today, we think that around September, October, the markets would have corrected enough for us to be able to do that. So essentially, we'll be doing that.
We
Right.
have
So we have, I think,
questions.
reasonable questions here. Between, let's take them.
Yeah, sure. So, what do you think people can make with us every year by investing with us? That's the question at 2:43 p.m. from Avil.
Right. So each year is a little difficult to say, but the way we look at returns is like this: that India's nominal, say, real GDP grows at 6-7%. There's a 3-4% inflation, so 10-11% is the standard nominal GDP growth, which includes agriculture. You remove the impact of agriculture, we are at say 12-13%. Assuming the unorganized to organized doesn't happen, let's work with 12-13% earning growth over a 3, 5, 10-year time frame. That's what we think the markets will return. Historically, post fees, we have delivered 8% outperformance. We think that's a little too much to expect. I think we'll be happy if we do 5 to 6% post fees, and that puts us somewhere around 17-18%. Equity, depends a lot. If you want to be very specific about entries and exits, then that 1 year return, matters a lot. But if you are willing to be a little more patient, be a little okay with regards to entries and exits, then this 17-18% is something that we think we can deliver.
Jigar, what about the Nifty P when the GSEC yield rises to 8.5%, if it does?
Right. Yeah, that's a fair number. We are at, I think, 7 somethings now. The repo can be hiked further, and essentially will be at that 8 handle is not out of the expectations. Nifty P is a tricky concept because let me give you a statistic. In FY22 over 21, the growth in Nifty earnings was driven by 4 companies, 50% growth. Tata Steel, JSW Steel, Hindalco, and ONGC. Put together, their weight is 4%. Right, so 4% was responsible for 50% of incremental profit growth. That in and of itself should have resulted in a valuation derating that could have come about, because obviously you're not going to value a commodity company as high as you would value a consumption business. So that should have resulted a higher yield obviously goes on to reduce the valuation multiple of an index. But as I said, it's the constituents numbers that matter a lot more. And therefore, we will not go as far as to put up a number there for the purpose of our investments. The PE of an index doesn't matter as much as the valuation of a particular business that we are buying. But fair to say that some contraction is something that one should be prepared for.
Right. And had we always been proactively shifting to defensive, then maybe we could have gotten much better performance if we would have always done that perfectly. But we are not perfect. We made this claim. I think we attempt to do it. Sometimes like I said, we underperform for a few months. Maybe we don't allocate too much to safety or too much to aggression when we switch stance across cycles, and we are okay to live with that. We don't have to go 100% into satellite stocks when we are aggressive. We don't believe in going 100% into defensive stocks when we are defensive. I don't think the investing game works like that. It's not an all or nothing.
Yeah, that is one part, Dipen, and also we have not always been right. I'll tell you the times when we can predict the market shifting to a certain number, we are very happy to do it. But every now and again, you will be hit with a thunderstorm that you have no way of seeing. I'll tell you, COVID 2019 or 2020, we did very bad because, when I can see in 2018 how the street is getting positioned, or in October 2021, that how the street is getting positioned, and, the numbers that were in front of us, we couldn't see that in COVID. And therefore we had a very bad March 2020, which we could subsequently salvage or more than salvage and come out on top. But I think it is virtually impossible to be completely defensive and not lose capital at all. If we could do that, we might try and do that, but I don't think it's crystal ball gazing, and then doing what we have done, we would still find us in the top decile, right? Having a very good up capture ratio. In the last cycle, we were up before fees something like 45% when the index was up 18%. And subsequent to March, we have fallen lesser than the market. Now, if you exclude the fees, we have actually managed to protect capital as well. So, doing what we do, we are still coming out in the top decile, like top 5%, maybe 1 or 2 on most months. So I think this is the extent of what we can do. Having said that, we also continue to, add more parameters. It's not an algorithm. I think there was one question
around that.
It's not an algorithm. 4 of us essentially do research on different sectors, and we have spent a considerable amount of time doing just this. Right? I could very well tell you what happens if China stops supplying steel to Southeast Asia and what is the impact on Indian prices. But if you ask me that same question about an IT company, that, okay, Boeing Cyient does some work for Boeing, and if Boeing 737 Max has an issue with regards to supplies, how will it impact Cyient revenue? I would have no clue. But I don't need to have a clue because of the way we are structured. Viral would focus exclusively on the sectors that Viral is focusing on, and we then become fund managers of the same sectors. Right? The other way, the way in which Street does it, is basically one person becomes the be all end all, and that ends up becoming the jack of all trades, masters of none. And you would see the funds, let's say a consumption biased fund manager is running your fund, you would see phenomenal numbers when the consumption cycle is on. But for him to give up investing into a 50 PE stock and start buying 5 PE stocks, which commodity businesses are, is not easy. Right? We have been able to do that because of the way we are structured, and that has sort of given a reasonably good return over the last few years. The last question then is, what is your earning estimate for Nifty and what sectors will lead? Right, I stopped short of my view there. Thank you for asking that question, Saurabh. See, we don't think there is a big risk to Nifty earning, frankly. 35 to 40% of the market is financials and insurance. I think that's never been better. The 20 years of me looking at it, I find the bank balance sheets the cleanest. KV Kamath says 50 years it's the best balance sheet. We'll stick with that. 10-12% is Reliance, which I think doesn't have a huge problem. You might argue that government's imposition of export duty dents profitability, but when those estimates were set up, nobody expected GRMs to be $25, right? Everybody's working off something like 10, 11. Most times it was single digit, $6, $7 per barrel of Singapore GRM, and that you add on top the Reliance complexity. So 10-12%, so 50%. Tech earnings are not bad. Valuations are correcting. So essentially, you add 12-13% of tech, that's going to be great. So broadly 70 to 75% of Nifty is going to be reasonably okay. We could look at something like 1000 on FY24 EPS. 750 goes to something like 875, which goes to 1000. I don't think there is a big risk there as far as at least the earnings is concerned. And Nifty PE, you're asking again, little difficult, as I said, but we have historically traded at a premium to Asia, which is at I think 13-14 times. We are currently at, let's say, 16 times if I want to take F24 numbers. We could go down to arguably 15, slightly lower than 15, which would put Nifty in the trajectory of 15,000 on FY24 basis. I think that would be the extent of downside. Obviously, the fall of 1,000 points or 2,000 points will be disproportionate on a few sectors. The way in which we are approaching the sector, to answer your first question, is I'll extend the analogy of the crude derived loss that we are staring at. The 2.5 lakh crore of money that needs to be absorbed will be absorbed differently by different sectors. For us, consumption is the worst hit because not only its earnings would get compressed, but the PE multiples that got expanded between 13 and 20 will need to come down. Yeah, because the PE, the interest rates have gone up. So consumption is one sector we are avoiding. I'll break it down in terms of GDP. So consumption is done. Manufacturing, it's a sector by sector call. I think autos are in a reasonably good stead. Auto ancillaries are in a very good stead. There are a few chemical companies that are able to pass on. There are a few, pharma companies that we think can pass on. So that is very clear. Manufacturing is sector by sector. And lastly, services is a free for all. We believe, if anything, the higher interest rate aids to profitability. The higher inflation aids to profitability for a banking company or an insurance company. And that essentially makes us the most interested in that space, which is also demonstrated from the way we are set up. We are the most overweight we have ever been on banks or insurance companies. So that's how we see the stock selection and the sector selection as we go ahead.
Right.
I think, Dipin, we are at 3 o'clock. If there are more questions, we are very happy to take it, as we will call it a day.
Yep. I think we are good to go. So
last
we wind up.
words.
Thanks everybody for attending. If you have follow-up questions, feel free to get in touch with me. Otherwise, here's my email ID and telephone number for those of you who don't have it on the chat window. And thanks once again, everyone, for coming in. We'll take your leave. Bye.
Thank you. Bye-bye.